Bring in Scott Siefers, Managing Director and Senior Research Analyst at Piper Sandler. Scott, it's not monolithic. Everybody's got different concerns, different balance sheets, different assets, things like that. I don't even know whether there's a lot of trouble spots, but you point out this whole deposit risk is probably going to continue. As a result, banks are going to be a little bit more conservative, probably, about liquidity. That means they're probably going to make less money because they're going to do less banking type activity. And then the regulators might come in too. And that could affect things. And so it seems to me like it's like an earnings warning that we've got to consider for all these banks.
Well, that's right. So thanks, Joe. I think you've raised a number of good points. You can almost look at what we're going through now as sort of a two-phase situation. One is the immediacy of the crisis, which hopefully, number one, we'll sort of get through soon. But two, I think what I'd stress in there is that for the most part, the industry does seem to be in pretty good shape to weather the immediacy of this crisis. I'm sure, for instance, a lot of deposits have moved into the biggest banks on the perception of safety, but I suspect there's also been just a lot of velocity within the rest of the industry as, say commercial customers in particular kind of diversify their funds. But net, it seems like we could be in sort of the same place where we started. That said, while this crisis seemed to come out of nowhere, it's exposed some serious blind spots in the system's infrastructure. And, I think, as I suggested, most banks are going to be able to get through this fine. There's an element of sort of well poisoning here, and there will likely be longer term ramifications. For instance, even though deposits may be holding in at the typical bank, I think the value of that liquidity has now pretty much skyrocketed. And I'm sure everyone out there is doing everything they can to kind of preserve it. So pricing, which we knew was an issue, we've traditionally called that deposit betas, that's likely just going to go into overdrive. I think moreover, banks are just going to have to be far more discerning regarding where and at what cost they deploy their liquidity. So what I would call the supply of credit, or sort of the supply of loans, seems likely to shrink over time, and the cost of that credit seems pretty likely to go up. And of course, as you, Joe, alluded to, the kind of the big wild card here is the ultimate regulatory response. It seems that banks will likely have to hold more capital, if for nothing else than to account for the swings that we've seen in these unrealized gains or losses that we're dealing with now. But it also seems possible they'll have to kind of reconstitute their asset bases. We've all become concerned, for instance, about this idea of uninsured deposits, which really wasn't even on anyone's radar screen a couple of weeks ago. But the biggest banks, for the better part of a decade now, have held on to a lot more cash on their balance sheet. It's hurt their margins, but they've become much more ironclad in terms of their safety. So to the extent that we maybe have to push that sort of a dynamic down into the rest of the system, it basically just kind of means a more conservative and probably lower earning group.